Well, hi there, everybody, and thanks as always for joining us in our Investment Review Committee Equity Growth Share Class Update for May 2018. As always, I have Alex Brandolini, Lead Portfolio Manager for the Equity Growth Fund. How are you today, Alex?
I'm doing well, thank you, Jason. Yourself?
Doing well, thanks. So we're going to start off, as always, just with some key points that you've been watching and compiling over the last month regarding the markets. So why don't we just start with a look at the technicals here?
Okay, so what we have here are a couple of interesting points. One thing that we can see is that the S&P 500 had a breakout above its descending triangle. That typically is a good sign. And as you can see from the chart, it's a decisive breakout. However, that breakout has stalled. Where it seems as though the S&P 500 is finding support is on its 100-day moving average. So what we would do is look for further upside from here. But if we do get a breakdown in that support line, we would expect a descent to the top of the descending triangle, or we expect we would find support at the 200-day moving average. And given the economic environment that we're in, as well as where we are in the macroeconomic cycle, I think it's quite reasonable to expect that. In fact, if we saw a short-term break below the 200-day moving average, in the absence of some significant unforeseen information, that would definitely be a buy signal, kind of like what we saw in March. There's a couple of days where the S&P broke below the 200, and that was definitely a buy signal. And since then, we've had some breakout patterns. So technically speaking, things look good. But let's get to the fundamentals. So the fundamentals is really what drives markets. And right now, equities appear to be following the lead of estimate revisions. So as you can see, we've got estimates for 2018, 2019, and 2020 in the white, orange, and blue lines. Back in February, when this correction started, you can see the purple line, which is the S&P 500, spiked lower, and estimate expectations kind of followed suit. And you had some choppy up and down behavior for the next couple of months until about April, when a lot of companies had gone through the most recent earnings season. And what we saw is the majority of companies were beating on the top line and beating on the bottom line. So again, quality performance, top line supporting the bottom line, and the analyst community, their pessimism was definitely turned around. And as you can see, later on, let's say mid-April and onward, all estimate revisions started to creep back up, as is the S&P 500. So we expect further recovery from here, given the fundamental outlook. However, a lot of investors are, kind of saying that, this correction is taking a little bit of time. And I know that I touched upon an average a few sessions ago where it's about 28 trading days on average to recover from a 10% correction. But that data goes back a couple of, maybe 2 or 3 decades. So I thought what it would be useful to evaluate was more recent data. So here I've got a graph of the last 4 corrections that's going all the way back to about 2009, 2010. And what we can see now is that the average time to recovery from a 10% correction is about 137 days, or let's call that 3 to 4 months. So I would say we're still within that window. I don't think there's any cause for concern just yet. The economics are still very supportive. The economic environment globally is still very supportive of markets. And as we've discussed in the past, we are in the mature phase of the macroeconomic cycle. We are expecting slower growth, but growth nonetheless in market returns. It's just those monthly market returns are going to be not as big as they were in 2017, but they're still expected to be positive. But what we do expect is a lot more volatility, and so far this year that has definitely been the theme. With respect to pool performance, on a 1 month basis, we came in at about at 169. Our index came in at 182. I would say that's an immaterial difference. Longer term, year to date, we're still outpacing our benchmark. We've got a positive 183, whereas the benchmark is still negative 278. So we are maintaining the alpha that we've created earlier on in this year. April was admittedly another month of continued volatility, so there haven't really been too many changes with respect to our holdings within the equity pool. We don't really like unloading positions in down markets. We do like accumulating positions or executing option strategies. So really, with the exception of Disney, there were no changes in the equity pool. We did execute an option strategy on Disney. We actually got into a synthetic stock position because the American dollar is a little bit bid up. We're not buyers of American dollars here at the moment, but nonetheless, we still like U.S. exposure, so we gained that through a synthetic stock position. Disney's studio performance continues to exceed expectations, and they had a significant release in April, which smashed the box office and broke some records. So it was a short-term trade there, but we did add Disney. We are kind of late in May right now, so I can't say that we have already unloaded Disney at a profit, but that was the only change in holdings for the month. Other than that, we were busy rolling puts on Facebook. Facebook had a significant recovery in the month from its Cambridge scandal. The company is still very unique in its space. It's a unique technology company globally. We think the company does fine long term. The analysts weren't too rocked by the event, so if the analysts are not really getting rocked, neither are we. What we were doing is rolling puts on our put writing exposure, and on any of our long exposure, we were writing covered calls. All of those strategies worked out really well. We were doing similar kind of things on Google, writing puts and writing covered calls at the same time. We did have some exposure to Europe. Europe had been creeping up. Technically speaking, hitting some resistance lines, so we were executing some covered calls there. And there are a number of other names that we were doing covered calls on, many of which expired out of the money, so we got to keep the premium, and we essentially were manufacturing dividends taxed as capital gains throughout the month. So a lot of strategies went well, and as I mentioned a moment before, we're not really buyers of U.S. dollars here. We did end up selling some U.S. dollars. So at the moment, we've probably got about 40% exposure to the country, to the United States, but we've only got about 20% exposure to the currency. So we've been trying to bank some returns on the currency management, and it's a month where overall the equity pool held its own. So we're quite pleased with the performance.
Okay, well, as always, Alex, thank you very much for your commentary for this month, and of course, looking forward to hearing more next month.